Welcome to Course 3, Unit 6, Lesson 6, What is Goodwill? So for any investor that's spent a lot of time looking at balance sheets, they're going to have noticed an item in there called Goodwill listed under the asset column. And the purpose of this lesson is to explain Warren Buffett's opinion on Goodwill and also Benjamin Graham's opinion on Goodwill. So hopefully as we go through this, it'll all make sense to you. And if you have any questions, make sure you ask it on the forum. So before we can start describing what goodwill is, we have to understand what tangible assets versus intangible assets are. So over on the left, you can see that a tangible asset is something that you can actually lay your hand on and touch. So this would be your plant, your inventory, cash, receivables, all those kinds of things. Now receivables, even though you can't touch them maybe right now, eventually you will be able to. So intangible assets are those things that you can't touch, and that would be your brand name, customer loyalty, patents, things like that. So in order to give you an example of where to find intangible assets on a balance sheet versus tangible assets, we're going to go ahead and pull up Apple, and I'll show you their balance sheet and show you where these numbers are at. Okay, so here we are at the top level MSN Money web page, and so what we're going to do is we're just going to type in the ticker for Apple, which is AAPL, and we'll go ahead and hit enter, and it takes us to the top level page for the Apple company. And so what we're going to do is we're going to scroll down over here to the left hand side where we can select balance sheet, and as you can see, the balance sheet has loaded. We have interim selected, so we're going to be looking at the second quarter for 2012 for Apple. So when we look at the balance sheet, as you remember, the balance sheet is broken down into assets and liabilities. And when we're looking at goodwill or intangible assets, we're going to find that under the top portion here, not under current assets, but under the second portion where the total assets are added up. And you're going to see goodwill listed, and you're going to see intangibles net. Okay? So for Apple, we can see that they have $1.1 billion listed for goodwill, and they have $3.6 billion listed for intangibles net. So if we're looking at the total intangible assets for Apple, it would be $4.7 billion. If we wanted to figure out what our net tangible assets were, you're going to take the total assets, you're going to subtract out the intangibles, which would be these two, and then you'll subtract out all the liabilities. So another shortcut is that you could take the equity and just subtract out your intangibles, which is your goodwill and intangible net right here, and that'll give you the same number. Now, for a company that would have preferred shares, which this for Apple, they don't have any preferred shares, you'd have to add up what the par value is for all those preferred shares and subtract that out of that total in order to get the net tangible assets. So after seeing that, you might be asking yourself, how can they list something on there that doesn't physically exist? How do they know what that value is? And in order to do this, I'm just going to demonstrate this with two different companies here. On the left-hand side, we're going to say that we have the Apple company. And then on the right-hand side, we're going to say that we have a smaller company called Best Apps. And we're just going to assume that Apple wants to buy out Best Apps. They want that company to fall under their company as a subsidiary. Okay, so whenever we're doing this, let's just say that the equity on Apple is $100,000 and that their net income for the year is $40,000. Okay, now I know that those numbers aren't accurate, but we're just going to use these to simplify this demonstration. We're also going to assume that presently, Apple has no intangible assets listed on their balance sheet. So both that goodwill and that intangible would be listed as zero. Okay. So then when we look over at the smaller company, Best Apps, we're going to see that their equity is only $20,000 and that their net income is $10,000. Okay. Now, if we remember, Apple's going to buy them out. So let's go to our next slide here. Okay. So let's assume that Apple is willing to pay $50,000 in order to acquire Best Apps. Now, when we look at that valuation of $50,000, we can understand why we would pay maybe more than the equity of the business for Best Apps, which is $20,000, because when you look at their net income of $10,000 a year, you can see that that's half of their equity, and they're going to be able to grow their equity very quickly with such a high net income. When you look at that ratio, that net income to equity, that's our return on equity, that's going to be 50%, which is extremely high. Okay, so because of that, Best Apps can sell their company for an enormous premium, And to be honest with you, it'd probably go for something like $100,000 opposed to $50,000. But we're just going to use $50,000 for this example to demonstrate how goodwill is added to a balance sheet. So let's also assume that Best Apps is owned by a single owner, and the guy's name is Ted, and we have a picture of Ted there. So in order for Apple to acquire Best Apps, they're going to pay Ted $50,000 for the company. So you can see that payment being made to Ted for $50,000 from Apple. Okay, after that purchase has taken place, as we look over at Ted, we can see that Ted has received $50,000 from Apple for his company. So he's got his money. He no longer has anything to do with Best Apps. But what happens is Best Apps now falls under their parent company, which is Apple, and Best Apps is now listed as an operational subsidiary because it's non-operational if it's less than 50% ownership. But in this case, Apple bought 100% ownership of this business, so it's listed as an operational subsidiary. Okay, so when we go to the balance sheet used to have equity for Apple of $100,000. But as you remember, Best Apps had $20,000 of equity that was acquired during that buyout. So on the balance sheet, you're going to see the tangible equity increase to $120,000. Okay? Now when we look at the goodwill, although that goodwill wasn't brought over to Apple, if you look over at Ted, he's still holding that $30,000 in addition to the equity that we paid him for. So how are we listing that $30,000 on there? And what it is, it's nothing more than us being able to add an asset to our account of the goodwill that we paid over the equity of the company. So since we paid $50,000 for $20,000 of equity, there was an additional $30,000 of goodwill that we paid to Ted, and now we get to add that onto our balance sheet even though we already paid it to Ted. Okay? So that might sound really confusing, and how we're allowed to add money that's not really there might be really confusing to people, but what we did is we just valued that company and what its intangible assets were, and we valued the intangible assets at $30,000. So we get to add that to our balance sheet during that acquisition. So our total equity would now be listed as $150,000. Okay? When we look down at the income statement, we can see that Apple's income from before the buyout is still listed at $40,000. And now we also have an additional stream of money, which is Best Apps income of $10,000. And so our net income for the whole business now is $50,000. So how was $30,000 created on the balance sheet? And this is what it is. It was the brand name, it was the customer loyalty, it was maybe patents associated with those apps. It was the employee knowledge of how to actually make those applications. And all of those things have value, and it's very, very hard to put a value on it. And this is how businesses do it. So prior to 15 December 2001, there was a very different way of accounting for goodwill on a balance sheet. Okay? Now, using our previous example, since you understand that example, we have $30,000 of goodwill on this balance sheet. So before 2001, the accounting rules were that a company would have to amortize that goodwill over a 40-year period in order to make that goodwill a tangible asset. So you'd have to turn that into cash over a 40-year period. And how they did that is you would take your $30,000 of goodwill, we divide that by 40 years to come up with a $750 payment. Okay? So what Apple would have to do in this generic situation is they'd have to pay $750 out of their income and then decrease their goodwill by that amount. So what it would look like after the first year is that instead of the net income being reported as $50,000, it'd be reported as $49,250. So their income is lower. It's being reported as lower because they have to take that $750 out of that profit line. Okay? And then the goodwill would be listed as $29,250. Okay? So it's also subtracted out of the goodwill. And what you have is after a 40-year period, the goodwill would have no longer be listed onto the balance sheet. It would just go away. and then the income statement, you wouldn't have to subtract that amount out of the income statement. So you would see like a boost in the net income and the EPS. So this is prior to 2001. This isn't used anymore. And there's a lot of people, a lot of managers, money managers, very happy that this is not used anymore. As you can imagine, having to amortize that goodwill over a 40-year period is going to have a drastic impact on your net income and what you're being able to report. To be honest, this accounting rule before 2001 really didn't make a lot of sense. After 2001, companies can keep the goodwill on their balance sheet without amortizing that premium. So you might be asking, okay, so if they don't have to amortize that amount and actually materialize that money anymore, how are you able to properly value a company when this goodwill is listed on it, and companies could be acquiring other companies for just ridiculous premiums, and there's no way of really keeping track of that. And so that's what I'm going to try to accomplish at this point. Since those accounting rules have changed and goodwill doesn't have to be amortized anymore, how do you properly value that? Okay, so let's turn to our friend Buffett here and see what his opinion is on goodwill. So his opinion of accounting goodwill, which I just described, is that it's nothing more than a number that's listed on the balance sheet. He doesn't really place much value in what you see on the balance sheet as far as that number that's listed under the goodwill. And he definitely didn't place a lot of value prior to 2001 when you were having to amortize that amount. So what he likes to distinguish is between accounting goodwill and economic goodwill. And so here's his definition of economic goodwill. Businesses logically are worth more than net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. The capitalized value of this return is economic goodwill. Okay, so I know that might be a little bit confusing because he's very concise with his words and he has it all compact into that quote. But what I'm going to do is explain that to you. Okay, so what is economic goodwill? So the first term that he throws out there is net tangible assets. Now, I briefly described that earlier. Your net tangible assets, go to the bottom line of your balance sheet and look at the equity. Okay, whatever that number is, you're going to then subtract out the intangibles, which is the line that says intangibles and goodwill. You're going to subtract both of those from the equity. Okay, and then you're going to subtract out any of the par value of the preferred stock. So most companies don't have the preferred stock, so all you're going to do is you're going to look at the equity and subtract out the goodwill and the intangibles, and that's your net tangible assets. Okay, so that's the magic number that he's really looking at whenever he's assessing that baseline book value of a company. Okay, that's the number. So when we were looking at our two companies earlier with these generic scenarios, we had Apple with an equity of $100,000 and a net income of $40,000. And if you remember, there was no intangibles on their balance sheet at the beginning of that scenario. So our return on equity and our return on net tangible assets was exactly the same at 40%. And the same thing as you look over there to the best apps, the equity was 20, net income was 10. And so our ROE and our return on net tangible assets was exactly the same at 50%. Now, you're not going to commonly see that because most companies have intangibles listed on their balance sheet. Let's figure this out for a company that has net tangible assets. So the second scenario, after these two companies had merged, we had $30,000 of goodwill listed on the balance sheet. So we're just going to say that that's all of our intangibles, is that $30,000 of goodwill. So when we do the return on equity scenario, we go over there, we look at our equity, it's $150,000, and our net income is 50. So we're going to take 50 divided by 150, and our return on equity is 33%. But what Buffett would do is he said, well, let's look at the return on the net tangible assets, okay? And so he would take that $50,000 in net income, and he would divide it by 120,000 instead of the 150. And what he did is he subtracted out the intangible. When he does that, you can see that that's a 41.6% return. So why is that number, that net tangible assets, important? And this is me kind of dissecting that original quote. So why is that important? It's because Buffett believes that economic goodwill is inflation-proof, whereas tangible assets are not. Okay? So when we looked at that last scenario right here, when we subtracted out that $30,000, what he's doing is he's looking at how much is it going to grow off the tangible assets, because that is not inflation proof. But the goodwill, that $30,000 of goodwill, is inflation proof. So what we're getting at here is that Buffett's opinion is that having some goodwill on the balance sheet isn't necessarily a bad thing, which goes completely against, Benjamin Graham, and I'll discuss that at the end, the difference between the two of them. But Buffett's opinion is that having a little bit of goodwill on a balance sheet isn't a bad thing because that goodwill is inflation proof. And what he does is he demonstrates this, and this is pulled out of his shareholder letters from 1972. He gives a demonstration of his opinion on goodwill and how it's inflation proof. And how he does that is he provides an example, and this is very similar to the example he provides with a little bit of difference. But for the most part, this is exactly the scenario that he describes in his shareholder letters. So what he does is he compares See's Candy to a boring square company, is what we're going to call it. Okay? And what he says is that the net income on See's Candy when he originally bought it back in the early 1970s was $2 million in net income. Okay, now his net tangible assets for See's Candy was $8 million. So you can see that his return on the net tangible assets was 25%. Okay, now what he did is he compared this to just a generic example of boring square company, and he says, let's have the same profit, the same net income of $2 million, but let's say that their net tangible assets are a lot higher, and let's just say it's $18 million. Okay, so it's producing the same profit, but it's got a whole lot of tangible assets sitting there producing that income. So when we look at the return on the net tangible, like See's, like I said before, it's 25%. And then when we look over at the boring square company, it's only 11.1%. And what his argument is that See's had a lot of economic goodwill, whereas the boring square company had little to no economic goodwill. So if we were going to use interest rates at 11.1%, and the reason I use that is because that's exactly what our return on our net tangible assets would be for the boring square company. Okay, so let's assume that our interest rate that we're comparing these two, that we're going to discount it all back at, is 11.1%. That would put a market value on See's at $15 million. Okay. And then the market price on the boring square company is obviously going to be $18 million, which is exactly where their net tangible assets are at. Okay? So looking at this company, you can see that they both have the same profit margin. See's has less than 50% the net tangible assets, but yet the value on both of these companies are very similar at 15 and 18 million. So this is where he really demonstrates his point. Let's assume that inflation occurs right now at 100%. Okay, so we went from the last scenario to this scenario, okay, and between those two scenarios we have 100% inflation, okay. Now when that occurs with See's Candy, let's go over there and look at them first. If you remember, the net income on the previous slide was $2 million. Now it's $4 million because we had 100% inflation occur. And since when that happens, Buffett says not only are you making double the net income, but what you have to do is you have to double your net tangible assets. So before we were dealing with $8 million for our net tangible assets, but in order to produce that $4 million, that additional $2 million on our net income, we had to double our net tangible assets. So when we double our net tangible assets to make that additional $2 million, we have to invest $8 million in order to make that additional $2 million. Okay. Now, let's go over and look at what happens with boring square company whenever we conduct 100% inflation. As you look at their net income, it also doubled up to $4 million. It used to be $2 million. When we look at the net tangible assets, it went from $18 million to $36 million. Okay? Just like See's, where we had to invest some money in order to make that additional net income, over here at boring square company, we had to invest $18 million in order to make the same exact $2 million that See's Candy made. Okay? So this is where it starts getting interesting, and I'm sure this can potentially get confusing at this point. So just stay with me, and I'm almost done here. The thing that you have to look at here is what impact does the market price have after all that fallout. Okay, so after that inflation all occurred and all those adjustments are made, how does the market price look between these two companies? Okay, so when we still use that 11.1% interest rate and we discount all that money back, okay, we come up with a market valuation on See's for $29 million. we come up with a market valuation for Boring Square Company at $36 million. Okay? Now, if you look, the net tangible assets for Boring Square Company is 36, and the market value is still 36. When we look over at C's, the net tangible assets are only 16 million, but the market value is almost approaching 30 million. So what does that all mean? Okay, so how is the one better than the other? So when we look at C's Candy, we invested $8 million, and it resulted in $6 million in additional dollars being produced in the market price due to the economic goodwill. Okay, and that's what Buffett's getting at. That additional $6 million was produced in goodwill because it kept up with inflation. Okay, that goodwill kept up with the inflation, and it resulted in an additional $6 million in market price. But when we look over at Boring Square Company, they invested $18 million in order to get that same net income, and it resulted in zero additional dollars on the market price, okay, on that nominal market price. So when you compare these two, when we look at the nominal growth that occurred between C's Candy and the Boring Square Company, C's made an additional $6 million during that inflationary period, where Boring Square Company made a zero nominal growth during that time frame. So a lot of that is very confusing. It can be very difficult to understand, especially when you're dealing with assets that aren't even something that you can put your hands on. But this is where we're getting into security analysis. So when we look over at the left, there's a picture of Benjamin Graham. And Benjamin Graham had the opinion that if a company would end operations, the net tangible assets are the only things that are left of the company, and therefore the difference between that market price that you pay and the book value that's in the company is your margin of safety. Benjamin Graham always liked to look at the company as if it was going to die tomorrow, and that the company wouldn't be living any longer, and that you had to be sure that when that company died, if and when that company died, you were there ready to collect whatever tangible assets that remain in the business. Now, in order to understand that mindset, we got to look at when Benjamin Graham wrote Security Analysis, which was in the 1930s, which was during the Great Depression. So that's probably why he had that mindset. So his student, Warren Buffett, who adopted almost every single principle that Graham came up with, kind of embellished on that idea. And Buffett's going to agree with Graham that the difference between the market price and the book value is your margin of safety. But, then there's a huge but here, Warren Buffett also believes that real economic goodwill is inflation-proof and therefore adds more value to a business. Okay? So you can see how Buffett has a twist on what Graham has written in all of his books. If you go read, Security Analysis or The Intelligent Investor, you're going to get Graham's approach of valuing the business as if it was dead, whereas Warren Buffett's kind of taken a new approach, and he likes to value the business as if it's dead and what is it going to be worth if it's alive. So he's looking at both aspects. So here's my take on it. Economic goodwill is great protection against inflation if you plan on owning your shares indefinitely. So if you're that type of person who truly is buying these assets just like Buffett and you plan on owning them forever, well, then you're probably going to see the fruits of your labor in that economic goodwill because you're going to experience inflation during that time. If you're not owning those assets for a long period of time, none of this is going to really take effect. This approach should only be utilized when future earnings are really strong and that the debt in that company is minimal. Because if you're not doing that, you're not going to be protected by paying a premium well over those net tangible assets. So in the end, it's my opinion that a balance between purchasing a company with some tangible assets for safety and an appropriate amount of goodwill is exercised so that you can minimize your amount of inflation that you're experiencing. So this is really a balancing act that you're going to have to do. This is something you're going to have to put a lot of thought into. I know this is kind of taking things to a whole new level, but this is how Warren Buffett thinks, and that's really what we're trying to accomplish here at the site and showing you some of these ideas. So this concludes Course 3, Unit 6, Lesson 6, What is Goodwill?